Okay, let's unpack this. ZENA, ticker symbol ZENA, a microcap tech company on the NASDAQ. Around April 2025, this stock was, well, making headlines for some pretty dramatic swings.
Yeah, big
We
swings.
saw intraday gains of, what, over 18% and nearly 33% on April 24th alone.
Huh.
Yet, if you look back over the previous year, the share price had just cratered, down like 74%, maybe 75%.
Oof. Yeah. So what's driving this roller coaster for Zenatech?
Right.
It's interesting. This volatility, it really points to a potential battleground, short-term speculation versus some, let's say, deeper, longer-term concerns about the company.
And Zenatech isn't simple. They're not just doing one thing.
No, definitely not.
Yeah.
They're involved in a pretty diverse set of emerging technologies. You've got AI-powered drones, enterprise software, even some early stuff in quantum computing applications.
It seems like their approach is aggressive expansion, both developing in-house and buying up other companies.
Strategic acquisitions, yeah, that seems to be a big part of the playbook.
Exactly. And for this deep dive into Zenatech, we've pulled together a comprehensive report. This is as of April 26, 2025.
Okay.
We're looking at financial data, their own company statements, news articles, kind of the full spectrum of info.
That's good.
Our mission today is really to distill the essential insights. What's the business about? Who's running the show? And critically, what's their financial health actually look like?
Trying to understand both the, let's say, the potential opportunity, but also the very real risks involved here.
Right. And if we connect this back to you, the listener, understanding Zenatech right now, it offers a valuable shortcut, really.
Yeah, it's a chance to see how a company tries to navigate these cutting-edge sectors, build a business.
But also see the challenges, right? The potential pitfalls.
Exactly. We're focused on giving you clarity, not drowning you in data, but pulling out the key takeaways for a hopefully well-informed perspective.
All right, let's get into the nuts and bolts then. Chapter 1, business understanding. Zenatech seems to be running a kind of hybrid model. Hybrid how? Well, they're developing and making AI drone hardware, but they're also heavily investing in drone as a service, or DaaS, especially in land surveying through buying up companies.
Right, I saw that. KJM, Wallace, Miller, Weddell. They've scooped up a few.
Yeah. And then there's the enterprise software as a service, the SaaS side, again, mostly built through acquisitions.
Pace Plus, Systems View, Tiller Stack. Yeah, bunch of names there.
And we can't forget the early stage quantum computing stuff. It's a broad scope.
It really is.
Okay.
This kind of multi-pronged strategy, while it could offer diverse revenue streams, it also brings in a lot of complexity, doesn't it?
For sure.
On the drone hardware side, they've got a few monitors. There's the Zenadrone 1000, that's their heavy lifter, aiming for an 80-pound payload, VTL capable.
Okay.
Then the IQ Nano for indoors, and the IQ Square.
Yeah.
That one seems aimed at indoor-outdoor surveying, maybe even defense uses.
And those spider vision sensors, using Taiwan-made parts.
Yeah, that's notable. It's relevant for NDAA compliance, the rules restricting certain foreign components. That could potentially open doors for U.S. government work.
Right, okay. So moving to software and services, that DaaS offering, the drone as a service, seems key, especially with those land surveying acquisitions. What was the goal, like 20 acquisitions?
Exactly like that, yeah.
It's ambitious.
So instead of buying the drones, companies just subscribe to a drone service for surveying. How does that work?
Pretty much. Usually, Zenatech would provide the drone, the software for planning flights and processing data, maybe even the operators, all for a recurring fee or maybe based on how much you use it.
Cheaper for the customer, potentially. More flexible.
That's the idea. Saves them owning and maintaining their own fleet. And beyond DaaS, you've got those SaaS applications we mentioned, Pace Plus, Systems View, et cetera, targeting different industries, plus the AI drone swarm tech and the quantum computing ideas for things like traffic management.
It's fascinating how many different pots they have on the boil.
It is. So revenue comes from drone sales, DaaS fees, subscriptions, usage, maybe both, and SaaS subscriptions.
Multiple streams.
But here's the thing. When we look at their full year 2024 revenue, it was just $1.96 million Canadian. That's roughly $1.4 million US.
Okay, it's not a lot.
And the year-over-year growth was only 7%. That feels like a really stark contrast to all these business lines and big plans, doesn't it?
It really does.
Their value proposition is all about innovation, automation, and cost savings for mission-critical operations.
Well, that low revenue figure compared to the big ambitions It's not just a number, right? It really highlights the significant execution risk.
How so?
Well, their strategy needs massive upfront investment everywhere, and that current revenue suggests they are a long, long way from the scale they need to be profitable.
So they're burning cash.
Highly reliant on continued funding or finding a way to accelerate growth really fast.
Okay, let's shift gears. Chapter 2. Management evaluation. This is where things get, well, potentially critical. The key person at the top is Dr. Sean A. Pasley, CEO and chairman. But here's the kicker. He's also CEO and the controlling shareholder of 2 other public companies, EPAZ, EPAZ, and Ameritech Ventures, ATVK.
Ah, okay. That's unusual and definitely something to look at closely.
We also have James Sherman as CFO, Sajada Seif as CTO, and Craigie Pasley as corporate secretary, likely related to the CEO.
Right, but that CEO overlap with EPAZ and ATVK,
Right.
that's crucial because when you look at how those 2 companies performed under Dr. Pasley, it raises some serious concerns.
How bad are we talking?
Both have seen, frankly, catastrophic share price declines, over 99% in some cases. EPAZ did a reverse stock split recently.
Never a good sign.
Right. It often suggests a company struggling, trying to boost its share price just to stay listed. And investor sentiment around EPAZ and ATVK seems, well, overwhelmingly negative.
Yeah, there's definitely a lot of negative buzz out there if you look. And it's not just leadership overlap. Dr. Pasley has huge control over Zenadrone.
Through his own shares.
Through his direct holdings, yeah, but also because EPAZ and ATVK, which he controls, are big shareholders in ZENA too.
Wow. Okay.
We also saw filings Form 144A, Schedule 13D, that indicate potential and maybe actual share sales by Dr. Pasley himself.
Those filings matter. They signal when major insiders might be selling.
So this whole tangled web of ownership and leadership, it immediately throws up big corporate governance questions, doesn't it?
Absolutely. Huge questions. And while the board lists some independent directors, I saw at least one report saying there were no independent directors.
A contradiction like that, that's a serious red flag, suggests potential problems with oversight, with accountability.
It really does. And look, while the sources didn't point to direct ethical problems within Zenatech itself, the history and the reputation tied to EPAZ and ATVK under the same CEO casts a really long shadow.
Plus, Zenatech has been buying assets from EPAZ and ATVK.
Which inherently creates potential conflicts of interest, right?
Definitely.
Right.
Now, communication-wise, Zenatech puts out regular press releases. But they tend to focus heavily on future stuff, new initiatives, tech advances, rather than digging into current financial performance.
Ah, the classic jam tomorrow strategy.
Kind of. And we also saw that ATVK had delayed filings. This pattern, hyping the future over the present is common for growth companies.
Right.
But given the CEO's track record elsewhere, it makes you scrutinize it a lot more carefully.
Absolutely. And while high insider ownership can sometimes be good, aligning management with shareholders.
The EPA's at ATVK history suggests it hasn't really helped outside investors there.
Exactly. Plus, Zenatech's growth strategy, especially relying on acquisitions, brings that risk of diluting shareholders down the line if they need to issue more stock to pay for it all.
So the key insight on management seems to be significant governance risks, all stemming from the CEO's other roles and the, let's say, troubling track record of EPAZ and ATVK.
Yeah, it definitely complicates any straightforward assessment of Zenatech's leadership. Adds a big layer of uncertainty you have to weigh.
All right, let's delve into Chapter 3, Financial Health. We're looking at data as of late April 2025, mostly using full year 2024 numbers ending DAC 31st, reported in Canadian dollars. Some trailing 12-month US dollar figures, too.
Okay, let's see the numbers.
Market cap around $61 million US, so firmly microcap. The price-to-earnings ratio, well...
Let me guess. Negative.
Hugely negative. Not really meaningful, which obviously signals they aren't profitable.
Right. What about revenue growth? You said 7% year over year for the full year?
Yeah, to $1.96 million Canadian. But there was a conflicting report showing a year-over-year decline in Q4 2024 revenue.
An inconsistency like that needs looking into. Yeah. Margins.
They paint a pretty concerning picture. Specific gross margin data was a bit sparse in the sources, but the trailing 12-month operating margin was deep in the red, like negative 227%.
Mine is 227%. Wow.
And the net margin was even worse, around negative 228%. For the full year 2024, the net loss was $4.04 million Canadian.
So losing way more than they bring in underscores that gap between revenue and expenses, the cost of those growth plans.
Exactly. Shows how much they're spending to develop tech and expand.
Okay. What about debt?
Debt to equity is about 0.59. Debt to capitalization around 31%. Now, those numbers alone might not seem crazy high.
But the lack of profits.
That's the critical question.
Yeah.
Given they aren't profitable, how do they service that debt?
Yeah.
And their free cash flow? Consistently negative. Q4 2024 alone was negative $1.09 million Canadian.
Negative free cash flow. That's a key indicator, burning cash just to keep the lights on and invest. So those debt ratios might look okay on paper, but without profits to cover interest payments. Major concern.
Big concern. And that sustained negative free cash flow raises serious questions about funding operations long-term unless they hit profitability or get more financing.
Yeah, definitely.
Their price-to-book ratio is around 3.8, which kind of suggests the market's still giving them a premium on assets despite the losses.
Interesting. Market hope springs eternal, maybe.
Maybe. In terms of overall financial stability, earnings are consistently negative. The net loss actually got worse in recent quarters.
Not the right direction.
No dividends, obviously. Interest coverage ratio is negative. Now, the current ratio short-term liquidity is 1.57. Might seem okay, but the quick ratio, which is stricter, excludes inventory, is super low, 0.09.
Whoa, 0.09. That's really low. Below 1 suggests they could struggle to meet short-term debts if they can't sell inventory fast.
That's a critical red flag, isn't it? Their immediate financial health.
Absolutely. Alarmingly low quick ratio.
Now, management has said they think they have enough cash for the next 12 months.
Okay.
But given that cash burn rate we saw in Q4 2024, you have to wonder if that's realistic without a huge improvement or more capital coming in.
Precisely. The rate they're burning cash versus their reserves. It just creates significant uncertainty about long-term financial sustainability.
So the core takeaway on financial health: significant, persistent unprofitability, high cash burn, really casts substantial doubt on their long-term viability unless something changes dramatically.
Oh, yeah. It's the profile of a high-growth, high-risk venture, but it definitely underscores how vulnerable the company is.
Okay, let's shift focus now. Second half of our deep dive, starting with Chapter 4, market sentiment. And the overall feeling around ZENA seems highly speculative and pretty negative overall.
Yeah, we touched on the volatility, the big price drops since the IPO. That speaks volumes, doesn't it?
It does. And places like Stockopedia called it highly speculative, even a sucker stock. JITA gave it a very low score, too.
That consistency across different platforms, plus the actual price action, it signals a broad loss of investor confidence over the last year or so.
And interestingly, almost no coverage from traditional sell-side analysts. No big brokerage firms putting out reports or price targets.
That lack of external validation, often a sign of higher risk, lower institutional interest. Makes sense.
ZENA does put out frequent news releases, though. Acquisitions, tech updates, regulatory stuff.
Right. But the stock's reaction to those just adds to the volatility.
Yeah, it feels like this constant news stream, while maybe meant to sound positive.
Can actually make it more speculative, people reacting to headlines without seeing the underlying financials.
Exactly. But here's a really telling indicator. Short interest.
Ah, how high is it?
Exceptionally high. Borrow fees are like 209% to 215%. High short volume ratio. And a really high short ratio, 56 days to cover.
Wow, 56 days. That is extreme. It strongly suggests a big chunk of the market thinks the price is going lower.
And those borrow fees, 200% plus.
That reflects huge demand to bet against the stock and the risk involved in doing so. Basically, strong conviction among shorters that the valuation is unsustainable. And we're seeing limited options activity too.
So despite the company pumping out positive news, the market, or a big part of it, is deeply skeptical.
Precisely. A clear gap between the company's story and how the market feels.
Okay, let's move to Chapter 5, ownership structure. And here, it's a story of contrasts.
How so?
Institutional ownership, minimal, like 0.8%. One source maybe hinted at 8.5%, but even that's still really low for a public company.
Yeah, very low. We're talking tiny holdings by some big names, but overall, not much institutional buy-in.
Which often makes you wonder about the level of due diligence and confidence from those bigger, more sophisticated investors.
It can definitely be a cautionary signal. They usually do deep research before committing capital.
Now compare that tiny institutional stake to insider ownership.
Let me guess. High.
Exceptionally high, and very concentrated. CEO Sean Pasley, between his direct shares and his control of EPAZ and ATVK, effectively controls well over 50% of ZENA's voting power.
Over 50%. Okay, that's dominant control.
Other insiders have much smaller stakes, but that level of concentrated control, huge implications for governance.
Indeed. When one person has that much sway, decisions might prioritize their interests or the interests of EPAs and ATVK over minority shareholders, reduces influence, limits accountability.
Information on insider transactions seems a bit limited, maybe because they're a foreign private issuer, different reporting rules.
Possibly.
But like we said, we did see those filings indicating share sales by Dr. Pasley. And get this, the top 23 shareholders own over 71% of the company.
Over 71% in the top 23. That leaves a pretty small public float.
Exactly. Which can add to the volatility and make liquidity lower, harder to trade without moving the price.
Yeah, that makes sense. And it just reinforces those governance concerns around the CEO's dominant role, especially given his track record with the other companies.
So the key takeaway on ownership, big disparity, very little institutional confidence, but extremely tight control by insiders, especially the CEO and his affiliated, less successful ventures.
Exactly. It really raises fundamental questions about whose interests are being served and highlights potential risks for anyone who isn't an insider.
Okay, let's move to Chapter 6, risk assessment. We've hit on a lot of these, but let's try a quick SWOT analysis summary.
Okay, strengths, weaknesses, opportunities, threats. Let's hear it.
Strengths. They're in high-growth sectors. That supply chain using Taiwan and Arizona could be smart. DaaS could be disruptive. They have growing patents, some FAA approvals, potential advantages there.
Right, areas where they could build an edge.
Weaknesses. Severe lack of profit, high cash burn, micro-cap status volatility. Depends heavily on integrating acquisitions successfully. Major governance concerns around the CEO, low institutional ownership, significant internal challenges.
Those are big weaknesses, critical vulnerabilities that could stop them executing their strategy.
Opportunities. Markets they're in are growing fast. Potential for U.S. defense contracts, scaling DaaS, maybe advantages from tariffs, commercializing new tech successfully, external factors that could help.
Potential tailwinds, if they can actually catch them.
And threats. Intense competition everywhere they operate, high execution risk just doing what they say they'll do, financial viability risk running out of money, changes in tariffs or trade policy, geopolitical risks with Taiwan, tech becoming obsolete, slow market adoption, and always dilution risk if they need more cash. Significant external challenges.
A long list of threats, potential obstacles everywhere.
Drilling down on the biggest risks, financial viability is huge. That cash burn, needing more funds, or sudden success.
Definitely top of the list.
Execution risk, too. Integrating all those acquisitions, scaling DaaS, that's complex.
Very complex.
The management reputation and conflicts issue. The CEO, EPAZ, ATVK, that's a serious governance risk.
Can't ignore that.
And regulatory hurdles. Getting NDA compliant UAS certifications for defense work, it's ongoing.
Right. So the number and just the severity of all these risks, it points to a highly uncertain future, doesn't it? Potentially a binary outcome, big success or complete failure.
Seems that way. These are definitely the key risks to watch.
Absolutely.
Finally, Chapter 7, brief conclusion. So, ZENA. It operates in some promising tech sectors. The strategy is ambitious, maybe even forward-thinking with that tariff angle.
Yeah, on paper, some parts look interesting.
Deep dive shows significant challenges.
Right.
Persistent unprofitability, big execution and financial risks, and those critical governance concerns around leadership.
And given all that, trying to figure out what the company is really worth intrinsically right now, it's exceedingly difficult, maybe impossible.
Pretty much. Considering everything, especially the lack of profit and those governance issues, it's really hard to see how ZENA aligns with, say, classic value investing principles.
Right, like Buffett's criteria. Understandable business, durable moat, trustworthy management, rational price. ZENA struggles on several of those fronts right now.
So based on our analysis as of April 2025, it really appears to be a high-risk speculative venture, not your typical value investment.
The potential for big returns might be there, sure, but it comes with an equally significant potential for big losses.
Precisely. The upside exists, maybe, but it's balanced by some very, very considerable hurdles and risks.
Yeah.
So let's circle back to where we started, those wild swings in ZENA stock price. What this deep dive reveals is, well, it's a deeply complex situation, isn't it? You've got this ambitious growth strategy in exciting areas.
But it's tangled up with serious financial problems and those big governance red flags.
Yeah. Their tariff strategy might be clever, offering a potential edge, but overall, it's a picture of a company with maybe considerable potential, but facing equally considerable obstacles.
Which really raises a fundamental question for you, the listener, to think about. In today's economic and geopolitical world, how much weight should investors give to a company's strategic moves, like mitigating tariff risks,
Versus?
versus its core financial stability and, frankly, the integrity of its leadership?
That's a crucial point to mull over. And just a reminder, this analysis is based on public info as of April 26, 2025. It is absolutely not financial advice.
Please do your own thorough research and due diligence before making any investment decisions.
We also want to mention that artificial intelligence was used in the research and compilation of the source materials to this deep dive. You can find the specific sources listed in the description.
And if you found this analysis helpful and you'd like more deep dives into public companies,
Please subscribe to the Stock Analytics AI YouTube channel. We appreciate your time today.